Debits and credits. It's kind of what makes accounting work. It's also what can make accounting students really frustrated if they don't get a hold of this. So this is not a topic in this course that you can say, oh, I don't get that, I just forget it and I'll concentrate and learn the next stuff that we do even better. If you don't get debits and credits, you can't do anything else in accounting. So spending some time here is probably the best use of your time all semester. So on the board, I have our accounting equation, which we also call what? The balance sheet equation, because it balances, right? Our left side always has to equal our right side. So you'll recall that a company has assets, all the stuff or resources they have on the left, and then the right side tells us who has a claim to that stuff? Anybody? And if they do, if creditors have a claim, we call that a liability because the company owes someone something, usually cash, but it could be services or something else. And then whatever's left over is the owner's claim to their own resources. And we deal mostly with corporations in this class, so we call our owners stockholders or shareholders. Okay. Hopefully also by now, you know that we break down this shareholders equity section into two pieces, stock and retained earnings. All the way until we get to the very end of the semester, we only ever talk about common stock. We'll learn there are some other types, but for quite a while, we just pretend that's the only type of stock because like its name, it's the most common. So I'm going to say shareholders equity is made up of common stock and retained earnings. Now, common stock is when owners just purchase a piece of the company, basically. Whereas the retained earnings sections come from the company actually earning income by doing whatever it's in business to do. So say if I had a landscaping company and I wanted to raise capital by selling shares of my company, I might sell you a piece of my company. You might buy 10 shares in it, but I haven't earned any income. That's basically me just raising capital, just like I go to the bank to borrow money. Whereas once I start providing my landscaping services, whether I'm designing flower beds or mowing lawns or whatever, that's when my actual earnings come into place. So of our retained earnings, it's made up of 3 different accounts. I want you to pause the video and make sure you can tell me those 3 accounts and what those accounts, what effect they have on retained earnings. Do they increase or decrease retained earnings? So hopefully you were able to stop the video and say, these are the 3 accounts that make up retained earnings: revenue, expenses, and dividends. And so I picture retained earnings as a big bucket of earnings the company earns. So as we earn revenue, that increases what we have retained, right? But expenses decrease what we've retained because we've had to spend it. And then likewise, dividends also decrease what the company retains because that's the company scooping into that retained earnings bucket and handing back earnings to the owners. So for the company itself, what they've retained decreases when they give dividends back. Okay, you know by now how to record journal entries, regular transactions that a business has. So I've got 3 very basic transactions here to convert now how we know to record transactions into debits and credits, the way that accountants keep track of things. So the first one says provided services for cash. And again, we can just use that landscaping business example for $100. What would we do? Well, what did we get? What did we give? We got some cash. How did we get it? By providing services. So those are my 2 accounts, cash. And when we provide services, that's called revenue. We've earned revenue. So on the left side under assets, my cash goes up by $100. And on the right side under revenue, my revenues go up by $100. I'm going to erase these 2. Okay, and we're still in balance, right? Left side's 100, right side's 100. I'm going to go through these next 2 real quick, and then we'll focus on the debits and credits. Number 2, borrowed $5,000 from a bank. What did we get? What did we give? Well, we got $5,000. So under cash, our cash goes up by $5,000. And we had to give a note to the bank saying, hey, bank, I promise I'll pay you back. That's a liability because we now owe that to someone else, the bank. I'm going to call that liability a note payable, and that increased by $5,000. We're still in balance here. Last one, purchased equipment for $1,000. What did we get? What did we give? We got equipment for $1,000 by giving cash for $1,000. So those are both assets. My cash actually goes down by $1,000, and I'll have a new asset called equipment that goes up by $1,000. And again, my whole equation is still in balance. My left side still equals my right side. So notice that you don't always have to touch both sides. In number 3, we only touched the left side, but one asset went down and one asset went up. So we're still in balance. Okay, so what are these debits and credits and what do we do with them? So there is an example that a lot of books use, and I use it to teach you, called the dealer chart. There are only 6 major types of accounts, categories in accounting: dividends, expenses, assets, liabilities, owner's equity, and revenue. You should know all those by now. What we do, instead of recording things across the board in this big transaction, because that would get really cumbersome, even if we were a really small business, we record things in something called debits and credits. And so the word debit and credit means nothing more than debit means left and credit means right. You might think, oh, debit means negative, because we kind of think personally, we all have a debit card, and when we swipe it, our cash goes down, right? But it doesn't mean negative. It just means left side of the equation, and credit means right side. I abbreviate them DR and CR often, and that's just the Latin abbreviations from the word that was created a long time ago, when I think some super old Dutch monk came up with this double entry bookkeeping to keep track of their Dutch trading. Okay, so this dealer chart is split right in 2, and what it shows you is how to increase an account. So if you have a dividend, an expense, or an asset, it's going to increase by making an entry on the left, or a debit. If you have a liability, an owner's equity, or a revenue account, and it's increasing, then you will make an entry on the right. And so looking at our balance sheet equation up here, hopefully that makes sense. Look in this first one, provided services for cash. Cash is a what? It's an asset. And notice how assets are on the left, just like they are in our dealer chart. So since our cash was increasing, we would record $100 debit to increase our cash. Revenue is over here on the right. Here's our R for revenue. Since our revenue was increasing, and remember, this chart represents increases, then we make an entry to revenue for a credit, or on the right. And again, looking at this long transaction, hopefully that makes sense, because you can see here's revenue over here to the right. Okay, number 2, borrowed $5,000 from the bank. We had an asset that went up and a liability that went up. Notice they're both increasing. Sometimes if it helps you, instead of asking yourself, oh, did the account increase or decrease, maybe say more or less, like liabilities. If you don't want to say that increased, you could say, oh, we have more liabilities now than we had before. We used to not owe anyone any money. Now we owe $5,000. Our liabilities have increased, or we have more of them now. So since our cash increased, we go, okay, cash is an asset. Assets appear on the left side of this chart. It's increasing, so I do just what the chart says, debit. Liabilities appear on the right side of the chart. Since it's also increasing, I do just what the chart says. Put it on the right side, and right side means credit. Now, watch for number 3. We do something different if it decreases. Number 3, we purchased equipment for $1,000. So we have an asset that is increasing. That matches my chart. Asset, this whole chart is increased. So that's going to be our debit. But what happened to our cash? Our cash decreased. What do we do now? I look at my same dealer chart. I know that cash is an asset. But this chart always represents how to increase an account. If we want to decrease an account, we simply do the opposite of the chart. So since the A falls on the left, if we need to decrease it, that's going to be with a credit. So I know I don't have an example of this up here, but if we had a liability that was decreasing, it would decrease with a what? With a debit, opposite of. So usually students, if they'll go very slow and methodically using their dealer chart, and you ask yourself every time, what is the account name? What is the account type? Asset, expense, dividend, what have you. Is it an increase or a decrease? Okay, now let's look at my chart and record it. Then students have no problem. What happens is you get in a hurry, you're on an exam or you're on homework, you don't feel like walking through all those steps, and it's super easy to tangle up your debits and credits. So spend some time on that. There's actually a worksheet in module number 2 in Canvas that I have a blank one and I have one with all the answers. And there's about 10 or 15 different transactions where you can slowly walk through this and practice it. And I'm telling you, this is, out of all semester, this is the best use of 30 minutes of your time if you can get this down. So that's basically the debits and credits, and I like to just show it with the dealer chart and the long transaction side by side so you can see why we're looking at left side, right side kind of thing. I'll point out on here, notice expenses are on the left, but where do expenses show up on this equation? Remember, expenses show up over here under retained earnings. So you think, well, why is that? If expenses are increasing, why do they show up on the left side when really we know they affect retained earnings on the right? Well, go back and ask yourself, what do expenses do to retained earnings? Do they increase or decrease them? They actually decrease retained earnings. So that's why expenses, as they are increasing, we record them with a debit, because really the more expenses we have, the less retained earnings, the less we are retaining, right? Just like you guys, you get paid, you got a bunch of cash in your account, but all of a sudden you've got those bills coming in. I've got to pay rent, I've got to pay my electricity bill, and woo, you see your earnings decreasing, right? So that's why expenses show up here on the left. Okay, the next video is going to show you a lot more about debits and credits and how to record them in these T accounts, but that was just a general idea of what a debit and a credit is.